Inflation has been going up like crazy. Inflation is now outstripping personal income growth. Over the past 3 months, consumer price inflation rose by 7%, while personal income increased by only 4%. Most Americans are experiencing a loss of their real purchasing power, a decline in their standard of living. In a recent survey, 9 out of 10 Americans said that inflation is the most critical problem facing the country. Inflation has become such a political hot potato that Joe Biden now says it's Vladimir Putin's fault. Can things get any worse? What is the truth about inflation? Today, I'm going to talk about the consequences of inflation. I'm going to tell you that there is no relief in sight, no happy ending, no light at the end of the tunnel. If inflation is not bad enough, I'm going to convince you that it will be followed by a recession in the not too distant future. The only good news I have for you is that Wall Street's complacency provides opportunities for early birds, that you still have time to prepare for the worst. Over the past 50 years, there have only been 2 other times when inflation significantly outpaced personal income growth, from 1973 to 75, and then from 1979 to 81. Both of these 2 periods were associated with severe recessions and stock market declines in the United States. These 2 periods have 2 themes in common. 1, a big surge in oil price. In the first period, there was the Arab oil embargo following the 1973 Yom Kippur War between Israel, Egypt, and Syria. In the second period, 7% of world oil production was lost as a result of the Iranian Revolution in 1979. 2, a rapid rise in interest rates. On both occasions, the Federal Reserve had to raise interest rates quickly to contain the inflation fallout of the energy crisis. The combination of the oil price shock and higher interest rates drove the U.S. economy into a recession at the end of 1973 and again in the beginning of 1980. What do these 2 recessions tell us about the U.S. economy in 2022? Oil prices spiked over the past year and the Fed has begun to hiking interest rates. Are we headed towards a recession? If there's one lesson that we can draw from these past 2 recessions, it is that it is futile to try to forecast exactly when a recession begins. Indeed, some of the most popular leading economic indicators fail to predict the timing of these 2 recessions. Take, for example, ISM Manufacturing Survey. This indicator was at best coincidental in the 1973-75 recession and a lagging indicator in the 1980 recession. Or non-farm payroll, the most widely followed U.S. data release. In both recessions, the creation of new jobs did not slow until after the recession has begun. What about household saving rate? 70% of U.S. GDP is household consumption. A big pullback in consumer spending is a necessary and sufficient condition in every recession. Here, the evidence is mixed. Household saving rate was rising in the lead up to the 1973-75 recession, but in the case of the 1980 recession, it rose only after the recession had started. And yet, something caused U.S. consumers to cut spending aggressively, setting off a chain reaction of falling output in employment. What was it? The answer is the stock market. The stock market fell sharply at the start of each of these 2 recessions. So here we have a chicken and egg problem. Ironically, if there's to be a recession, the stock market will decide when it will start. But what caused the stock market to go down in our 2 examples? The culprit was monetary policy. In both periods, interest rates were rising in the run-up to the stock market drop and the recession that came afterwards. This may sound obvious, but is an important takeaway. What it means is that rising inflation per se is not enough to bring on a recession. However, interest rate hikes in response to rising inflation might just do the trick. High inflation is not necessarily a problem for the stock market. Much more crucial for the stock market is what the Fed will do to rein in inflation. In modern economies, monetary policy works through the so-called financial conditions. The idea is that the tighter the current financial conditions are, the slower the economy will grow in the future, and thus the higher chance that lower inflation will materialize. When looking at the history of U.S. financial conditions as calculated by the Federal Reserve Bank of Chicago, what immediately stands out is just how tight financial conditions were in the run-up to the 2 recessions we discussed, and how easy they are now. This would suggest that for the Fed to bring down inflation, financial conditions will have to tighten much more. Will the tightening of financial conditions in 2022 lead to a new recession? The U.S. economy has changed a great deal in the past 50 years. The received wisdom is that increased efficiency and flexibility in both the labor market and the goods market meaning financial conditions won't have to tighten as much as in the past to bring down inflation. With both S&P 500 and its cyclically adjusted price-to-earning ratio not far from their respective all-time high, it is very clear that the market is giving the Fed the benefit of doubt. This is also why Wall Street still expects the U.S. economy to grow by 3.5% this year and earnings of U.S. companies to grow 9%. In my view, there are two problems with the current Wall Street consensus. One, the Federal Reserve is already behind the curve. It has never happened before that the Fed is starting to tighten policy when the inflation genie is already out of the bottle. Yes, the Fed has been too slow in taking away the punch bowl of easy money. This is why they're talking up 50 basis point hikes and reducing their balance sheet to drive up long-term interest rates more quickly. History tells us that when central banks are playing catch-up, bad things can happen. Two, Americans have lost confidence that economic policies can make inflation go away. A recent Michigan University survey shows that half of all consumers unfavorably assess current policies, which is more than 3 times the 16% of people who assess them favorably. In other words, the Fed also has a credibility problem right now. This is making their job even harder and could even force them to over-tighten to compensate. I believe the fact that the Fed is behind the curve and has lost credibility is the greatest risk facing the US and the global economy and financial markets. With no end to the Ukraine war in sight, with the arrival of Omicron in China threatening to shut down the global supply chain, with inflation outpacing personal income growth, with significant tightening of financial conditions still ahead, I'm inclined to think that a recession is a foregone conclusion. The question is not will there be a recession, but when. My bet is that it will start before Thanksgiving. In case you're wondering, I'm feeling better about myself with the stock market finally rolling over this week. What's more, I'm feeling more confident about my thesis of an approaching recession and eroding corporate profit margin that I talked about last week. What this means is that I remain very bearish about the stock market. The big story this week was the surging yields on US inflation index bonds. 10-year real yields went up 25 basis points. This is the 4th week in a row that real yields have risen. 10-year real yields are now at minus 0.18%, the highest level in 2 years. The suggestion in the Fed minutes that the Fed could start shrinking its balance sheet already in May took the market by surprise and drove up real yields, the real barometer of US monetary policy. Long-term US real yields are the benchmark risk-free rate that all assets are priced against. The jump in real yields by raising the bar for all the markets drove down the prices of almost everything else from Bitcoin to tech stocks to emerging market debt. The million-dollar question now is whether the rise in real yields is set to continue. I think so, and this is why. First of all, we have to remember that only a week ago that the Fed stopped its asset purchase program. The Fed was buying $120 billion of bonds every month only until 4 months ago. Now that the Fed is done buying, somebody else will have to pony up $120 billion every month to keep the US government funded. In the past, when the Fed was reducing its bond purchases, the size of the US budget deficit was also shrinking. This made the end of quantitative easing in the past less of an issue. What is different about this time is that not only the Fed ended QE more abruptly than in the past, but the net issuance of US government bonds and notes remains very high. All this begs the question of who will buy what the Fed is no longer buying. It does not look like it will be US household, I can tell you that much. Despite rising bond yields have made bonds more attractive, US bonds, mutual funds, and ETFs have seen steady outflows over the past 2 months. What about commercial banks? Will they be stepping up to the plate? Unlikely. Indeed, US banks have also been selling US government agency bonds over the past few weeks. I guess that banks don't want to catch a falling knife either. What about foreigners? Foreigners are big buyers of US bonds. They have always been. This is how US current account deficit gets financed. Over the past years, foreigners have bought about $400 billion of US bonds. Can they buy more to make up for the end of QE? Very unlikely. They're already buying at the peak pace of the past 10 years. With the US freezing the dollar reserves of the Russian central bank, I suspect foreign reserve managers, whether they be the Chinese, the Saudis, or even the Indians, might think twice before buying more US assets. All this means is that long-term real yields are heading higher. At zero, it will only reach neutral territory. The Fed probably will be open for it to go to 1% like it did at the end of 2018. Real yields will keep going up until someone decides to buy the bonds the Fed won't be buying, will be soon selling. The money will have to come from somewhere. One way for the market to clear is for the stock market to go down so that people buy more bonds as a safe haven. It amazes me that given everything that's going on, the inflows into equity mutual funds and ETFs year to date are at the highest level in 10 years. I guess after 2 straight years of double-digit returns, retail investors think the equity market can do no wrong. I think they're in for a big surprise. All in all, I'm staying with my short S&P 500 short position via SPXU. I'm also staying with my long position in nominal government bonds via IEF that will do well even if real yields were to go up as long as stocks go down. For my 60-40 portfolio, I am staying max underweight stocks and modest overweight bonds, basically going to next week. Now let's bring in John to find out what's on his mind. Hi John, what caught your eyes last week? Also give us an update of our portfolios. Finally, what can we expect in your more buyers than sellers column tomorrow?
Thanks, David. Now, as you well know, the worst criticism for a strategist is that they are a contrarian indicator. Well, in his effort to mediate between Ukraine and Russia, Emmanuel Macron became exactly that. Every time he spoke with Vladimir Putin, Russia did the exact opposite to what Macron said. Now, this is not the only reason he's been losing support to Marine Le Pen. The rise in support for Jean-Luc Mélenchon is evidence of this. However, if the election in Hungary is any indicator, the war in Ukraine has made many Europeans rethink their attitude towards nationalism. Now, I think the most likely scenario is that Macron will pull ahead again once he begins campaigning in earnest. However, it's clear that markets have been blindsided by this race and are not at all prepared for Le Pen victory. As such, I think we're likely to see some significant volatility in European assets over the next couple of weeks. Now, in our 3 model portfolios this week, we were positioned for lower equities. The bond portfolio was neutral duration and did well to avoid credit or the dollar, so it ended the week with a nice 11 basis points gain. In the 60-40 portfolio, our gains from being underweight equities were largely offset by being overweight bonds. The sector portfolio had a rough week, having been short energy and staples. I think that a short in oil stocks is actually acting like a long volatility position in oil. While oil stays elevated without getting too high, oil stocks are in a Goldilocks scenario. Now, in more buyers and sellers this week, we're looking at China. Despite what you might have heard, China has consistently had the least restrictive lockdowns for the past 2 years. That seems like it could well be about to change.
Thanks, John. Next week, I will be off with my wife in London for Easter Sunday, so see you in 2 weeks.